Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, May 14, 2015. Inside the numbers tonight, the first thing we're going to discuss is why is the market going higher? Right? We've been talking about it forever, been telling you to buy the dips, but we're going to recap and kind of refresh our memory as to what's really going on out there. And we'll talk about some numbers as it relates to the SPY and the EMini contract, as we normally do. We'll talk about crude oil and the fact that it hit a little bit of a slick today, and we'll recap the numbers and what we're looking for there. Gold hit an important number today, then melted away after making a high. We'll discuss the interest rates and bond market and the U.S. dollar, and let's get right over to the SPY chart. But first, let's discuss what's really going on out there. So I wrote down a few things because everything I'm going to tell you we've discussed before, but it's good to bring it all back together for a second. So first off, you had one of those typical, it seems like 2-3 times a week you have a Fed governor coming out saying, we're going to do this or we're not going to do this, we're raising rates, we're not raising rates. And then if the market happens to be going in any particular direction when that occurs or after that occurs, that becomes the reason for the direction. Well, that's what happened today. You had one of those governors again talking about the fact that he doesn't believe there's going to be a Fed rate hike in June. I don't think there will be either, but that's besides the point. The point is that the market was higher, the market continued higher, but part of that, at least in the news cycle I saw, part of the higher prices are attributed to the fact that the Fed governor came out and said there's no rate hike expected in June. It's nonsense, but regardless, that's one thing. So that happens time and time again. You had a plethora of rumors all week long. Why does that happen? It's options expiration. You had last week, let's start with last week, you had CRM, meaning Salesforce.com, was going to be bought out by Microsoft or Oracle. That didn't happen. That's not going to happen. You had GE was going to buy Crude. You had a rumor today with Avon Products and some phony company going to buy Avon Products. I don't even think the company existed. You had SanDisk was being bought out by Apple yesterday or the day before. I mean, it's every day. It's like 1, 2, 3 rumors a day. And I don't know where these come from. I don't know why the authorities allow these rumors to be actually published in writing, allow them to be discussed on TV. It's just mind-boggling to me, but it happens every month during options expiration week. And really, I think it should be outlawed or banned or something. It's just nonsense. But anyway, so that's another thing. Then, more importantly, what you have is you have what we'll call the liquidity cycle, okay? Remember, we talked for a long time, we talked a lot of times about the ECB pumping money into the market. Mario Draghi swears he's not going to let the market go down or he's not going to let the liquidity dry up. We have Abenomics over in Japan. They're pumping trillions of dollars into the market. They're buying equities. They're buying the market. Okay, let's not forget about that. Okay, if you think the market's going down and you're selling short against its central bank, guess who's going to win? Not you. Okay, so that's the old "don't fight the Fed" thing. It's don't fight the Fed, don't fight the ECB, don't fight the central bank in Japan. Don't fight they have more money than you do, okay? They have more money than all of us put together. Don't fight those central bankers, okay? So that's another area of where the liquidity is coming from, right? All the money that the Fed over the last 5 or 6 years pumped into the markets, don't forget, a lot of that never reached the market. A lot of that is still on JP Morgan's balance sheet, Bank of America, Goldman Sachs, Wells Fargo. It's on the bank's balance sheets, right? What the Fed did was they went into the banks and they said, I'm going to buy your horse crap, I almost said something else, assets. We're going to buy your depressed mortgage-backed securities. We're going to buy your depressed collateralized mortgage obligations. We're going to buy your collateralized debt obligations, your auto loans, all that stuff. How do you think the money got on the bank's balance sheets? The Fed bought stuff they didn't want that was depressing the actual earnings of the banks because they had to take write-downs of the poor assets or continue to mark those assets to market. Remember the term mark to market from 2008, 2009? Mark to market. A lot of those assets came off the bank's balance sheets by virtue of the Fed buying them. So the Fed takes the assets. Now the risk is shift to the Fed or shift to the taxpayer, right? You and me. And on the bank's balance sheet, it's replaced with fresh hard money cash. Well, eventually that money makes its way into the system, right? Auto loans, consumer debt, home loans, refinances. Well, that has been taking place, but it's not all here yet, right? We still haven't seen that rush to liquidity. We haven't seen the retail investor panic buy into the market. You will see that before this is all said and done, okay? Not this week, not next week. I'm just saying that's coming, okay? So now where are we in the market? All right, that's enough of that. Well, what else do I have? So where are we in the market? So let's go to the intraday chart. Let's go to the 60-minute, actually, for example. So remember the Fibonacci retracements that we played so perfectly all week long? Well, guess what? Off the table. Why? Because we came through the high. That means that we had 100% retracement and we closed above that, which means that those retracements from high to low is off the table. It's no longer valid. We're at new highs. Okay, so basically what we had today was we had basically just a gap higher and go. Oh, that's not what I wanted to do, but I want to show you the 10-minute chart, and I want to show you where we opened up today. Okay, market opened up. The open was, let me go to the EMini contract for a second because it's very important. It's so unbelievable how this stuff, I mean, if you're not paying attention, right, and you're not writing down these numbers that I'm giving you, okay, then you're at a disadvantage. Okay, let's go to the open today. All right, where's the open today? Oh, yeah. You know what? I'm on the continuous chart. I'm on the 24-hour chart. Doesn't matter where it opened today. I'm going to tell you where it opened today. Let's go back to the 60-minute chart. It opened today at 2107. Okay, remember when I was saying any hop over or any close hourly above 2105 up in this area here? Okay, guess what? Where do we open today? Above that area. That was a hugely important area. Okay, so we opened above that area and the market went higher. So what's the next level? Well, we really have two more levels. We have 2111 and 2115. And both were satisfied today, meaning if we closed hourly above 2111 and then actually captured and closed above 2115, that would be very, very significant, okay? So I think there's higher prices coming. How high? Well, we talked about these numbers before, and we'll talk about them again. So I've given you, in the past, I've given you 21.23, I've given you 21.25, I've given you 21.30 to 21.35. They're all in play right now. Tomorrow and Monday, they're all in play. And however, okay, what happens from that point? Do I have anything higher than 21.30 now? I don't even know on Friday or Monday whether we breach 21.25 or higher than that. But what I can tell you is that we do have a short-term cycle day, a short-term daily top scheduled for Monday. Now, what does that mean? Does that mean we go down Monday? No. That means that we have a top scheduled plus or minus 1 day on Monday. So it could be tomorrow, and it could be Tuesday, and it could be Monday. Okay, so just understand that we're going to be in this window of a short-term turn over the next couple of days. So it's something to be aware of, especially with options expiration coming to a close. And, after next week is Memorial Day. So I had always thought we would trade down into Memorial Day, and then Memorial Day would promote a turn, and then we would trade higher into the summer. So that's kind of what I have mapped out, and it doesn't seem to be happening that way. But if we have a turn on Monday or thereabout down, then I will put that one back on the table, back on the drawing board for a possible scenario going down into next week or throughout next week, and then looking for another buying opportunity for another leg higher after Memorial Day, really into July. So that's kind of where I am in the markets, and that's what I have mapped out, my little roadmap. But right now I'm looking for immediate higher prices, probably another $1 or so higher in the SPY. If we go back to the SPY, I'm going to refresh your memory of something else. Let's go to the weekly. Do we find it on the weekly? Is it still even there? We had a 212. Where's this high? Yeah, 212.97. Where's the daily chart? Oh, it's back in the past. So it's 212.97. Let's go back to the weekly for that one. 212.97 from December 19th was the high. So do I think we're going to get up to the 212.97? You better believe it. Okay, we're at 212.21. Of course we're going to get to 212.97. Are we going to bust through 212.97? I don't know. I think we'll probably stall out at 212.97. And if you think about it, almost another dollar higher. You know, by the way, it could be 213.20, 213.25, you know, and then pull back. So if you think about it, another dollar higher on the SPY takes us to about 213. And then if we look back at the EMini contract, another 10 points higher equates a dollar. Let's get rid of some of these lines by going back to the daily chart. If you go a dollar higher on the no, I wanted the SPY. I'm sorry, I was right. If you go a dollar higher in the ES contract, the EMini Futures contract, where does that take us? 21.27, 21.30, 21.25. You see how those numbers start to make sense? When they start to coincide with each other, they start to make sense. When targets in different markets start to converge, and I take these calculations from even the ES and the SPY, even though they're really the same market, it's the S&P 500, but I'm getting the calculations by doing different things on different charts in different markets, and they come out with the same thing, so that becomes meaningful to me. And I know I spent a lot of time in the S&P 500 tonight by virtue of the ES contract and the SPY, but I think it was important. So I just wanted you to get the full picture of what I'm looking at. So before we move on to the gold and oil and that other stuff, let's just look at the other side of the coin, right? We have to look at the other side of the coin because I want to give you a vision of both the high side and the downside. So let's take a look at the IWM, just as a comparison, a confirmation or non-confirmation, okay? Now, the IWM was up about 1% today, but guess what? So was the S&P 500. Interestingly enough, on this kind of a bullish day, I would have thought the IWM would lead the market higher, and all you did today was come into the 50-period moving average. Now, look at the SPY, daily chart, okay? Making new highs. IWM, not making new highs, okay? That's a little bit troublesome to me. That's a non-confirmation. I just want to take note of that. It's not telling me to do anything yet. I just want to take note of it. Something else I want to take note of. What happened to the transports today? The transports on a day like today should be extremely strong, okay? They're weak, all right? Where are we in the transports? Weak, okay? These are some lines I had in there on the transports. I have some retracements that I'm going to just show you what I'm looking at. See, I look at these markets all day, every day, but I don't show them to you every day unless there's something really to discuss. There's something to discuss here. So we have a Fibonacci retracement level drawn in from this low here, which was from, this is a weekly chart, from the low in October up to the high made in November. And the transports have been really kind of selling off or trading sideways ever since. Well, guess what? Okay, we're not making new highs in the transports like we are in the S&P. We're actually weaker in the transports. The transports were only up less than 0.5% today, while the Dow, the S&P, the Dow was up 1%, the S&P was up 1%, and the NASDAQ was up 1.4%, and the transports were weaker. So do I think the transports could come down and test the 50% retracement and or the 618? Yeah. In fact, the 50% retracement is really close upon us, and we've been hovering here for quite a long time. So if we started down next week for some reason, I think we would look for 83.15 in the transports, which is the 618 retracement. So let's get a zoom in or zoom out. Where does that take us on the daily chart? Right here. Okay, so I think the transports are a little weak, and if we saw any downward pressure in the market, this is where I think we'd find great support. Just something to note. So I talked about the IWM, talked about the transports. just evidence of non-confirm, or evidence of weakness that is out there. So everything isn't rosy all the time, but I just wanted to make mention of it. All right, let's move on to gold. Gold was interesting. It was almost like a laydown, right? Gold came right into the 50% retracement at 1225. Okay, and just bear with me one second. I just want to look at something on another chart. Bear with me. Yeah, okay. So gold came into the 1225 and pulled back a little bit. And if you look at the 60-minute chart, if I can bring it up, okay, you can see where gold came in, made a high today of 1227.70. And then kind of just melted away all day. Nothing wrong with gold. Pulled back a little bit. Could there be higher prices? Sure. I just think that the market was a little tired. We came into, in fact, let's go back to the daily chart. And what happened? You came into the 50% retracement that I have drawn in for you. And, the next target is really the 618. But first, I have this level at 1231. That I have had here for quite a while. That's an important level in my work. It's not a fib line. It's not a Fibonacci retracement. It just happens to be a calculation I make another way. In my work, it's actually called a square, and I think we'll get there. But we could pull back first, but there's certainly higher prices ahead for gold. But it could see some backing and filling. So I've been telling you that, it's been a tricky market, but once we got above 1212 and then 1215, that was pretty obvious to me where we're going to see 1225. And I know some of you took that trade because you emailed me so. So nice job. Oil. That's the USO. So oil, here's where we are. So, we had a little pullback in oil today. And we got the rejection from the 60-50. We pierced through it. Now we're struggling to maintain above that level. And we still have the 58.63. That's very important, okay? So we're well above that. So I'm not ready to give up on oil just yet. In fact, it's still in a bullish position, above all the moving averages, above 58.63. But you could see a couple of days of worth of pullback in oil just to work off some of this overbought condition, also to trick people in thinking that the high is in. So may or may not be in, but right now there's just no trade on the table. We have to see another chart pattern to emerge before we're ready to take another trade in oil markets. So that's really where we stand. Not much has changed. Bonds. Bonds, I don't like it. You can probably, this is waiting for the TLT to come up. Let me bring up something different. Bear with me. Okay. We tried to rally today a little bit. If we go into the 10-minute chart, even of the TLT, and just take a look at what we have, we tried to rally, pulled back. There's nothing good here. There's no sign of a bottom. I'm not willing to put capital at risk at this point. Maybe you get a bounce off this bottom, maybe you don't. But at this point, I don't see a definitive low being put in just yet. So I want to see more. Let the market tell us that it's got a low in. It's a good level, but 115.43 is a better level. I showed you that one last night. Where does that come from? I think I showed you last night. If I hadn't, I'll show you tonight. It basically comes from a Fibonacci retracement. And I didn't put the number exact, and that's why it's off a little bit. But it's a 618 retracement from this low to this high. Maybe the market bounces before we get there. But if we get there, it's really a great trade. If we don't get there and the market goes higher, so it goes higher without me. That's fine. I don't mind that. I would just rather take premium setups. I don't want to take trades based on, well, it looks good, it should hold. I want to take trades based on, I have to be in this trade because the market is telling me that this is a great level to trade. It's making a bottom. It's a Fibonacci retracement, and you just can't not take the trade. Those are the trades I want. So not ready yet. Let's go over to the dollar, and same deal on the dollar. Let it come to us. Let it come down a little more. I'll show you the longer term picture. I showed this to you last night. Look at this. Look what's going on here. If in fact the dollar finds support and goes higher, great. We'll hop on. We know where it's going. It's going well above 100 once again. But if the dollar came back in to test the trend line that was the breakout level, my golly gee, that would be just an all-out buy with 5 hands. Forget about 3 hands, because markets love to come back and retest these levels. Remember, what was the trade we had where we took the what was it? We took the trade on a head and shoulders pattern. Was it Yelp? Or we didn't take it because it was earnings. Yeah, that was it. Look at that. Look, I had that all set up. Look, the market, here's a head and shoulders pattern. Okay, we didn't take it, but it rallied back up and collapsed back. Now we're rallying back up. But this is the same type of thing. The market came to the underside of this. Now flip it around again, and we have on the dollar, if the market comes to the breakout point of this trend line, then it's an all-out buy, and that's just the way it is. So right now, until the market tells us a definitive low is in place or it's making a bottom, we're just going to wait for it to tell us what to do. I know it's a long video tonight, but I tried to give you everything I had, give you as much information as I can think of, and that is found in my notes here. So hopefully it's helpful. Hopefully you're making some money with this stuff. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.